Good evening and welcome to another Invest in GH webinar. I'm your host, Prince Henry Danquah. Happy New Year to all of you and thank you for joining us this evening. We are glad to have you here. Okay, so this webinar is proudly brought to you by Invest in GH. For those of you who are joining us for the first time, Invest in GH is the leading provider of financial news and education in Ghana. And over the years, our news, magazines, and webinars have been delivered to thousands of people in Ghana and beyond. And would like to thank you all for joining us, for being with us all these years, and for patronizing our work. We've had webinars that have covered topics in investing in mutual funds, stocks, cryptocurrencies, and real estate. And all our previous webinars are available for streaming on our YouTube channel, Invest in GH. Invest in GH. This webinar is also streaming live on our YouTube channel. So if you're unable to join us via Zoom, or you know someone who is unable to join us, please do well to copy the link that has been provided and send it to that person. If you don't have access to the link, we'll post it in the chat session soon so that you can share it. Also, if during the course of this webinar you have any questions for our host or for our guest speakers, please do well to type them in the chat session here or under the comment section if you are streaming on YouTube. Okay, so today we will be discussing where to invest in 2022, where to invest in 2022. And we are glad that you have made time to join us. Our hosts are here. Let me just add them shortly. Okay, so our speakers just join us. Where to invest in 2022 is our topic for today, and we have two high-profile speakers who are joining us for this discussion. They are in the presence of Dr. Ohene Kwapong and William Mensah. These are two speakers who will be taking us through this discussion. Our first speaker, Dr. Kwapong, he is the founder of the Songhai Group, that is a corporate development company. And he is also a board member of Parkstream Nordicom in Denmark, and also a board member of Ecobank Ghana. He has over 30 years experience in the investment banking industry, having served as COO, EMEA, Asia, Credit Trading and Structured Markets at the Royal Bank of Scotland. He has also held senior management positions at the New York City Economic Development Corporation, Deutsche Bank, GE Capital, and Microsoft. Oak holds a PhD in Nonlinear Systems Engineering from Columbia University, an MBA in Financial Engineering from MIT Sloan School of Management, and he also received an graduate degrees from MIT. So that's Oak, very high profile there. Our second speaker, William Mensah, he's an executive director at Bora Capital Advisors Limited, and he has over 17 years of experience in the investment banking industry. His experience includes portfolio management of listed companies and private equity. He has also held directorship and management positions in Kiddie Fund and EDC Balanced Funds, NDA Capital, and EDC Stock Brokerage Limited, where he was involved in the IPO of Ecobank Ghana, Transor Limited, and ETI. William has an MSc in Finance from Cass Business School in the UK and a bachelor's degree from the KNUST. Thank you for joining us, speakers, William and Oak. Can you hear me?
Yeah, I can hear you.
Okay,
yeah,
great.
I can hear you.
All right. So I think we'll begin with Oak for him to brief us on the global markets, the international markets. Then we'll have William talk to us about the local markets, which is Ghana. And then after which we will take questions and inquiries or whatever it is from the audience. So if you have any questions, please don't forget to put it down here in the chat session. If you have any challenges also, you can just put it in the chat session. We'll respond to you shortly. So Oak, I'll hand over to you here so that you take us through.
Okay. Good afternoon, everyone. Unfortunately, I'm joining only by audio because I have a bit of an emergency that came up yesterday. So I'm actually driving right now to Vermont. So the time sort of coincides. So hopefully my co-host, William, will help me out and do a bit more of the discussion. But I'm on video, I'm on audio right now. So I think the way I want to sort of set the way I want to set the background is this. You know, there's a lot that is happening in the world today in terms of money, capital markets, and basically how the world is changing, right? And whether you like it or not, is going to impact you one way or another. So if you work in Ghana, if you work outside Ghana and whatnot, overall, the world is moving in an environment right now where prices are going up. You know, rent is going up, gas is going up, your daily expenses are going up. You know, asset prices in terms of what you pay for rent are all going to. The world basically went through a period where interest rates were all low. So you had to borrow money to buy a car, have to borrow money to do anything. You had a bit of lower rate. Bank of Ghana was able to take the rates from long time ago, 20% all the way to about 13% right now. The US took its rates all the way to zero. Germany, the rates went below zero. So that is the environment, the COVID situation, that environment, and you have to think about how you take your extra money, your income or whatever funds you have, and say, how do I actually invest in this environment such that a year from today, a year from now, 2 years, 3 years from now, I will actually be a bit more financial gain. So that is sort of the environment that and the environment everybody is operating in. The interesting thing is that every time the world has gone through disruption like we've been through with financial markets because of COVID, and
Hi, Oak, can you hear me? Oh, can you hear me? Okay, I think Oak is having a bit of a challenge with his network. So we just have William take over. William, can you hear me?
Yes, I can hear you, Harry. Okay.
Okay, great. So you can take over from here.
Okay, let me see if I can share the screen. Okay, can you see?
Yes, we can.
Okay, so I'm hoping that this session will be more of a discussion than a lecture, because I have some introductory comments, some of which Oak has already started talking about. So you would see that a lot of things that he started saying are also in my slide. So just a few introductory comments, and then we would make this rather largely a discussion session. So usually, when you ask the question, where should I invest in? People would expect that you would hear, oh, this is a good time to invest in fixed income because of ABC, put your money in fixed income. Or put your money in the stock market because of XYZ, put your money in real estate because the real estate market is booming, put your money in cryptocurrencies is the new thing going on, invest in businesses, that's the sure way of growing wealth, buy derivatives, etc., etc. People want to hear prescriptive things to do. However, it's quite a dangerous way of approaching things, because there are no prescriptions when it comes to the best things to invest in. Because there's no such thing as the best investment. What is a good investment for person A will probably be a very terrible investment for person B. I mean, because of a number of factors. One, your investment objectives might be very different. Okay, depending on what you are investing for, one particular investment might be good for you, another investment might not be good for you at all. So there's nothing like the best investment for any group of people. And I also want to say that we have to be very careful about hot investments. These days, it's very easy for you to hear that this thing is hot, put your money in this is what is going on, this is what is going on. And we have to be very careful about that because, first of all, there are certain things that are packaged as hot investments and they end up being empty shells. There are no investments at all. Secondly, some investment might be good for someone because of his particular risk tolerance or his particular understanding, etc. But it may not be good for you at all. So we have to be careful about hot investments that come up. For all of us, we need to just keep our focus on our financial goals and stick to a plan. Very often we get distracted, and then when we get distracted, we tend to start moving money around. And the more we move money around, the more money we lose. We lose money because we move money around into things that are supposed to promise high returns. The money goes and the money never comes back. Or even if the money comes back, you end up moving money around so much that you incur a lot of transaction cost, which reduces your overall return on your investment. So it's always advisable to have your financial goals, have a long-term plan, and then just stick to it. It might be simple, it might be boring, but stick to it. The reason why it's good to stick to it is that it's something that you are comfortable with. A good investment for you is an investment that is good for who you are and your particular investment needs. So you need to identify what that is and stick to it. Well, I'm going to talk about the various things, what's happening in the fixed income space, what's happening in the equity space in Ghana, and then what my expectation of those ones are. But I want you to, even when you are listening to that, listen to it with the right mindset. But it's important to remember always that the return of your money, the return of your investment must come before you start thinking about a return on investment. If you focus on the return on investment and you do not consider how risky the investment is this going to come back at all? You may end up losing some principal. And the way money works, the effect of compounding, money compounds over a long period of time and becomes very valuable. However, if you end up losing part of the money because you invested in something that never came back at all, it becomes very difficult to get your compounding back on track because it will set you back a lot. So these are a few things I want us to bear in mind before we start talking about other things. And I hope that the discussion session would also throw up many more things. Okay, so factors to consider when investing. I have only one slide focusing on Ghana, and I have a few thoughts on what is happening internationally. Now, Oak started talking and saying that there are certain things that are happening, and whether you like it or not is going to have an impact on your investment. There's no other way you can put it. Everything that is operating and making money is operating and making money within a certain context. We are all operating within a certain economic environment. There are certain things that happen that has long-lasting effect, and sometimes will change the cost of asset classes and returns for a long period of time. So what I have on the screen here is a snapshot of the Ghanaian economy before COVID and then after COVID. So a few things that are important. So if you look at the boxes at the top, it shows us Ghana's fiscal deficit. So basically, how much income we are projecting to earn in a particular year, how much expenditure we were expecting to incur in that year, and what was the deficit, by how much did we fall short. Now in 2017, our fiscal deficit was 12 billion cedis. 2018, it was 11 billion cedis. 2019, it was 14 billion cedis. And then COVID entered in 2020. From 14 billion cedi deficit, the deficit jumped to 41 billion, a deficit of 41 billion. 2021, still a very high deficit, 37 billion. And in 2022, government is projecting that we are still going to have another 37 billion cedi deficit. Now, this is a very worrying trend because this has a direct impact on our debt to GDP numbers, which have a lot of implications for us as people who want to invest. What's going to happen to the assets that you are investing in? You cannot run away from it because it's an environment in which you're operating. Now, underneath those boxes on top, you see this line. We have a gold line and you have a red line. Now, these lines are showing us our debt to GDP ratio, how much debt we had compared to our gross domestic product. Before, the gold line is showing us what the figure is without COVID, and then the red line is showing us what the figure is with COVID. Now, so we see that our debt to GDP ratio is significantly higher because of the overspending that is happening due to COVID. Now, and so what? There are a lot of people who hear economic data and they say, oh, how does this affect me? The effect on you is very real and very direct. Now, so in 2022, we are expecting to fund $37 billion in deficit. How do we expect to fund this $37 billion in deficit? First of all, you have to understand that even the revenue target, we don't even know if we are going to meet the revenue target. As we speak now, the infamous e-levy is still hanging, and there's still a lot that needs to be done before e-levy can come on stream. Now, I saw some data yesterday about the decline in mobile money transactions. When the e-levy was announced. So this is not when e-levy came into force, when e-levy was announced. Even the mere announcement of e-levy led to a reduction in mobile money transactions. So there's a real possibility that e-levy will be introduced and it will fall really short of the revenue that it is projected to bring in. So our revenue, meeting our revenue target is something that is even in doubt. Now, the question is, are we able to reduce our expenditure to be able to meet the shortfall in our revenue? Now, then you have to look at what goes into our expenditure very well. And all of us who follow these things, that's where we get worried, because you look at our expenditure and the bulk of the expenditure goes into paying interest on existing debt, which you can't do much about, interest on existing debt, and then also paying public sector wages and government sector agency expenditure. Okay, so a lot of that, in fact, those two things together exceeds domestic income. Okay, the money that we are able to generate domestically from our taxes are not enough to pay for our interest on existing debt and public sector wages. So that creates a real problem. Now, so what is the effect of this on you as an investor? As we speak now, the yields on Government of Ghana Euro bonds, the monies that we borrowed from international investors, the yields have gone up significantly, and we have yields around 12%. Now, what does that mean? What it means is that people who are holding our dollar-denominated bonds are scared about our numbers selling the bonds. And when they sell the bonds, price falls, interest rates go up. So interest rates on our dollar-denominated bonds are going up. Now, if interest rates on our dollar-denominated bonds are going up, it presupposes that it will be difficult for us to go out internationally and borrow more. So the probability of issuing new Euro bonds and raising money internationally is very slim if the trend continues, where yields on our dollar-denominated bonds are in double digits, 11%, 12%, 13%. Now, so that would mean that largely deficits would have to be financed domestically. Those of you in Ghana, you already know that university students are at home. Lecturers are on strike. There's a lot of agitation among other work groups, all pushing for an increase in salaries. Now, all this puts a lot of pressure. Now, if we don't have access to borrow money internationally, and even our expenditure, we don't know how we'll be able to keep a tap on our expenditure. And there's agitation for more salaries and people are on strike and all that. Now, the pressure on domestic borrowing is going to be very high. So, if nothing changes, if government, now we heard that there was a word out there about government trying to cut down expenditure by 20%. That'll be good if it can be done. Now, if you are not able to cut down expenditure and we have to come into the market and borrow a lot of money within the short term to meet recurrent expenses, then what's going to happen is that all the stability that we've had in our interest rate regime, where we've been able to keep short-term interest rates significantly low, now it's gone back up to about 13%, but we've been able to keep it low compared to where we're coming from, where short-term interest rates used to be about 24%. We stand the risk of all this being eroded. Now, if this should happen, then what it will mean is local businesses will not be able to compete. If government itself is borrowing short-term at what we used to have maybe 6-7 years ago before we now moved to IMF, local businesses borrowing at, government itself borrowing short-term at 24%, 23%, 22%, then really local businesses don't stand a chance. Because if I have money and I can lend it to government in the short term and then 24%, what will be the incentive for me to give the money to any business to do anything else? Okay, so that has a real impact on what's going to happen to interest rates. And on the flip side, what the effect will be on real businesses, companies that are operating within the economy. So that is, this picture is something that is troubling, and is something that has a real impact on what's going to happen to investment assets. And for that matter, what decisions that you should take when it comes to your investment. All this is pointing back to the earlier point that I made that the return of your investment is more critical than the return on your investment. This is showing us that there is a real risk. Let me go to the next slide and also talk briefly. So this is also looking at, again, the environment, but here we're looking more at it from the global perspective. So our previous speaker started talking about this. He talked about global inflationary trends. It's very real. Now, real return in the US, so if you take interest that you earn, if you buy debt-free instruments, and then you take out inflation, how much your purchasing power is going to reduce over the period that you are holding that asset, and you take that out, you have a very big negative real return. Now, you cannot have a negative real return over a long period of time. Basically, a negative real return means that you get punished for investing. Okay, now, so high inflation, negative real return, unless policy makers believe that this is a very short-term trend and it is likely to correct itself. You cannot let an environment like that continue. High inflation, negative real return. You cannot have it continue. Now, the US is not adjusting interest rates. They are taking an approach where it says this is a short-term trend, this is going to change. Now, if it doesn't happen and it appears as if it's becoming a mainstay, they would have to address it head on. Now, if they address this head on, what it will mean is they would have to increase interest rates very sharply to bring down inflation. Now, there are other factors that this would create a problem for, because there are asset bubbles on the market. Now, people, anytime there's a bit of instability in the market, people are always looking for other places to put money, and sometimes it creates an opportunity for bubbles to be created. Now, this is where prices of investment assets go up to levels that don't make sense if you look at it in terms of what the asset can really return. Last week or 2 weeks ago, I picked my kids from school, and my 15-year-old was like, "Daddy, I think you should buy Ethereum, buy Ethereum." I said, "Why should I buy Ethereum?" He says, "Have you heard about Nifty's?" I said, "Yes, I know Nifty's forever. Like, I've known about Nifty's for a long time." He says, "Man, it's cool. Buy Ethereum." So then I asked him, "So why should I buy Ethereum?" "Because of non-fungible tokens." He says, "Oh, it's cool." And then I asked him, "Okay, now, so if I buy Ethereum, or if I buy what you think is cool about Ethereum, if I buy a non-fungible token, if I buy a non-fungible token, which is like in layman's terms, so take it like digital art, okay, and I say, so if I buy this non-fungible token and assume that no one wants to buy that asset in quotes that I've bought, what will I derive from it? What is the fundamental value of that thing that you want me to buy? Assume that there is no market for it. So I buy the non-fungible tokens and I have it in some wallet somewhere. And I said, do something for me. I says, no, I do nothing. I just sit in a wallet. Okay. Now, so bubbles are created when you have things that are priced very high, and then you cannot relate those high prices to anything fundamental that that asset can do for you. Now, the other global thing that is worrying is that asset prices, especially in the stock market, because interest rates have been zero or very low over a long period of time, people have borrowed money and put it in the stock market to the point where the stock market is trading at price multiples that are higher today than they were before the 2008 financial crisis. Price multiples today in the US are higher than they were before the dot-com bubble. Now, so all these points together, high inflationary environment, asset bubbles, high price multiples, means that we are sitting on the brink of a monumental correction. Something drastic has to happen for things to go back to the normal level. Now, the thing is, no one can tell you when this correction is going to happen, but you always see the elements of it before it actually happens. Okay, so the probability that something monumental, we're going to have some disturbance in financial markets is high. And now, there is no market that is decoupled. I remember when I started working as a young stockbroker, and we used to put together slides and do presentations for fund managers in the US and in Europe to come and invest in Ghana. One of the things that we used to say was that our market is decoupled from other global markets, thereby reducing your risk, such that if something should happen in Europe, something should happen in America, it's not going to have an effect on asset prices here. So that creates some kind of a hedge for you. At that time, 2003, 2004, when we were putting together those slides and doing those presentations, it was true, but not anymore. Markets have changed significantly such that there is no market that is decoupled. When the US sneezes, everyone catches a cold. Or China can also sneeze. US and China, they should not sneeze. When they sneeze, everyone catches a cold. So no market is decoupled. And anything that happens internationally, the ripple effects are going to be felt everywhere in every market. So what should we do? Okay, so now let's look at asset classes. The people who put together the seminar said I should focus on the local market. So let's look local in Ghana. What should you do? We've already seen that interest rates on government securities, long-term government securities, have started going up. And some of them are not even really long. I mean, you can buy a 3-year government bond today and earn 20%. Okay, 3-year, 4-year, 5-year government securities with maturities above 3 years, most of them are trading at prices that give them a yield of 20% plus, 20%, 20.5, 20.8, thereabout. Now, so these are long-term government instruments. So these are supposed to be on the lower end of the risk spectrum. These are the rates that we are seeing on that level. Now, if you start seeing rates like that on that level, it should tell you that domestic risk for investment is high. Now, the other safe places that we used to put money outside of government. So if you don't want to invest, if you don't want to give your money to government, traditionally in Ghana, the other safe places that we used to do is to give money to the financial institutions whose business is to lend money to the people on government payroll. Okay, because that tends to be very low risk. Money is deducted from source, from people's salary, right, from source, and paid to the financial institutions that have given loans to them. So we used to feel very comfortable there. However, even that space, which is supposed to be a very comfortable space, there are some shakes, little bits of things happening in there. So for instance, for 3 months or 4 months now, people are paid their salaries all right, but the portion of their salaries that are supposed to go to financial institutions that they have loans with, those monies are not going. That should tell you something. Why will those monies not go? Because if those monies go, it means that government on a month-by-month basis is paying more money out than they can afford to pay now based on the fiscal conditions under which we are, income versus expenditure. So anything that we can hold on to, we are holding on to, including people's salaries that are supposed to be to pay for loans that they have. Okay. Long term, that I don't think is going to be a major problem. But if it continues, if this trend does not change and we cross 6 months, most of these companies will have to start making provision and treat these monies as if they were not going to come. Eventually, they will recover them, but their books will start looking bad. Those who are not in a strong enough financial position, Bank of Ghana is going to ask them to beef up capital, etc., and it might lead to some problems. So the already shifts that we're seeing, and these are supposed to be places that traditionally are very safe. Okay. Now, if you move beyond the guys who are lending money, as you can see, I didn't talk about bank fixed deposits at all. They are also supposed to be safe, but in our environment, it makes very little sense for you to buy bank fixed deposits because most of the banks are offering rates lower than you would get if you lend your money to government. So those of you who have bank fixed deposits, that's one of the things that you have to check. Remember that you can lend your money to government for 91 days and earn 13%. Now, so if your bank is giving you 9%, 8%, really, they are communicating to you that they are taking advantage of your lack of financial wisdom, okay? Because you cannot increase your risk by giving your money to a bank that can go bankrupt today for 8%, 9%, when you can give that same money to government who can print money and pay you back, and government will give you 13%. So if you are in that position, Monday, go to your bank and try and do something to correct it, because it shouldn't happen. Okay, so I'm not talking too much about that. Okay, now, so besides those lending money to government payrolls, other financial institutions that have been lending money to SME and the real economy, they are all struggling. All of them, not one is in a decent position. I'm talking about the savings and loans and the finance houses. Well, I will not say not one, but it's hard to find people in that space who are not struggling. Now, the reason why they are struggling is because the businesses they are trying to support are struggling. And the businesses are struggling, then they would struggle. Because what we have dealt with as far as COVID is concerned has been very different. You know, I'm sure probably a question we'll get is, what's up with all this inflation and why this high trend? Now, this inflation across is not only in the US, it's not Ghana. Inflation, we didn't meet our 9% target. We're around 12%. Now, it's a trend everywhere. Now, the reason is that, you know, during the COVID time, most economies, what they did was to do quantitative easing, put money in people's pockets. The US was giving everybody a paycheck, putting money in people's pocket. Now, the reason why quantitative easing is done is because you believe that people will now go out there and spend this money. As they spend this money, businesses would have the money and they'll be able to hire people, they'll be able to increase inventory, etc. Then it will kickstart the whole economy. However, COVID was very different. So you've given the money to the people, they want to go out there and go and spend the money. However, these businesses that they are going to spend the money with are facing logistic problems, supply chain issues. Okay, so an example, if you take automobiles, there was a chip shortage across the world. So companies are not able to produce new cars in quantities that they would want to. So now you've given money, you put money in people's pockets. They want to go out there and go and buy an automobile. There's a limit in supply of automobiles. So what's going to happen? Then the price of used cars start shooting up. Okay. And it's the trend everywhere. Okay. So it's very different. So people who lend money to, especially SME, you know, the SME space in Ghana have their own issues. Even before the recent trends, they have their own issues. Now, so they are struggling. Now, equities. The Ghanaian equity market is a very interesting market. There are some low valuations on the market that is very difficult to even imagine. So what do I mean? Let me say this thing. For those of you who have any interest in equities, anytime you are doing any kind of analysis to invest in equities, you have to think as if what will your decision be if you are going to buy the entire business? Okay, that's the way you need to think about it. If you had enough money to buy an entire business, will it make sense for you to buy that business? Now, when you look at it that way, it will make your decision making quite easy for you. Now, so I'm saying some of the valuations on our market are ridiculously low. Let me just use one as an example, CalBank. Now, CalBank is trading at a P ratio of 2. So remember I said, when you're analyzing any equity that you want to invest in, think about it as if you are buying the whole business. Now, a P ratio of 2 means that for every 1 cedi of net profit the company makes, you are paying 2 cedis for it. So assume that you had enough money to buy the whole of CalBank. Okay, 1 year from now, the profit that that company will make, remember now you own the company 100%, so the profit is yours. The profit the company will make is going to be half of the money you paid. Okay, so you pay 1 million cedis to own a business. In 1 year, the business makes a profit of 500,000. Can you imagine? If the next year they're able to make that 500,000 again, 2 years of net profit would have covered your initial investment. Okay, ridiculously low valuations, selling below book value. Again, what it means is that if you had enough money to buy CalBank 100%, you can decide that you are not going to run the bank for 1 day in your life, but rather you're going to sell all the assets of the bank, pay off all the liabilities the bank owns, and then keep the rest in your pocket. Now, CalBank's price to book ratio is about 0.5. Now, what that means is that if you had enough money to buy the whole bank 100%, you could sell the assets today, pay off liabilities, and then for every 1 cedi that you put in that company, you walk away with without running the company. Companies don't sell that cheap. But why has this been the case? This has been the case because our stock market has looked quite unattractive for a while, and everyone has shied away. And the more people shy away from it, the cheaper valuations become. I read an article by Warren Buffett, something that he talked about a while ago, and I shared it with all my friends in the equity space in the market. And what Warren Buffett was describing in the 70s is exactly what we are seeing in Ghana today. For a 17-year period in the United States of America, 17-year period, you had a situation where the index barely moved. Like if you look at what the index was at the beginning of that 17-year and the end of that 17-year, nothing really happened. In between it, you have the ups and downs, but over the long term, basically it was like the market was flat. And he said in that article that pension funds, who are people who are managing long-term funds, their percentage holding in the equities market in the US dropped to under, I think, about 5% or something ridiculously low. And that I found very interesting, because one of the things that we've been complaining about in Ghana is that the pension funds in Ghana are not buying any equities, even though they have long-term funds to manage. But there's a reason why they are not doing that. They look back over the last 10 years and they say, why would I, based on what I'm seeing, put money in this market when the beneficiaries of the scheme are not going to benefit if what is happening in the market continues? So I found it very intriguing when I read Warren Buffett. I would send that article to Harry so that he would share with the participants, but very insightful that even in the US for a very long period, nothing really was happening. You had the ups and the downs, but really the market was flat over the long period. So we've had very cheap equities in the market. Now, the National Pension Regulatory Authority has come out with a new directive that is saying that by the end of 2022, all pension fund tier 2 schemes must have constituent funds. Now, these constituent funds means that you cannot have one omnibus fund that everybody is a member of. There should be different funds to take care of different investment needs of people. Those who want to take higher risk should be able to have a higher risk portfolio, etc. It should not be like what we are doing now, where there's one portfolio for, in most of the schemes, there are a few schemes that are different, but in most of the schemes, there's only one portfolio. Now, the directive is that if people don't elect where they want to be, you have to put them in particular portfolios by their age. And they said for everyone who is between the age of 25 and 40, at least you must have 15% of their portfolio invested in either the stock market or in private equity. Now, so that what it means is that the probability of a lot of demand going into the stock market is high. When the demand goes into the stock market, I did some very rough calculation, very rough, and I really underestimated it. But per my underestimation, we should see between 1 and 2 billion seeds going into the stock market when this comes into effect. Okay, now when that happens, a lot of this underpricing that we are seeing, it's not going to be as underpriced as it is, because the schemes will go in and buy these assets that we are identifying to be underpriced. Okay, so, but that is a very short-term way of thinking. Okay, there's going to be correction, upward correction, but that is just a short-term thing. But long-term, what is going to be the effect? The long-term, the real thing that matters is what is the strength of local businesses? How stable, what is the stability in the fiscal environment in which we are operating? That's what's going to affect, or that's what's going to determine returns that you are going to make if you invest in equities in the long term. Okay, but short term, I foresee some correction. However, I hardly advise anyone, especially to go into the stock market thinking they are going to make a short-term return. I'm just telling you the factors that you should consider, or the things that are going to impact asset prices and investment returns in 2022. That's what I'm mentioning. I'm not saying anyone should go and speculatively buy equities thinking that demand is going to increase and then I'll cash out and make a quick dollar. No. If you want to buy equities thinking there's long-term value in this equity, I want to buy it and make long-term return. If you make a huge profit short-term and want to take some gains, that should just be a bonus. Okay, so that's the way to think about it. But really, the key thing is the economic environment within which these companies are going to operate. If we don't get fiscal stability soon, and if we don't see a situation where businesses can plan, forecast long-term, and take decisions that are going to increase their business long-term, then even though asset prices are low in the stock market, we might see this undervaluation extend over some more years. Now, other areas that people invest in, cryptocurrency, currency trading, day trading, etc. I would say that because of all the uncertainties that I've talked about, those of you who are investing in these things, not knowing exactly what you are doing, but you are just in that space wanting to make a quick dollar, I would advise that this is the time that you have to start retreating, because if there is any monumental correction in the market, if there are any shocks in the market, those are the assets that get hit the most. Okay, when the bubble bursts, those are the ones that will get hit the most. So if you are heavy in those things, you have to start considering, looking at all the uncertainty in the markets. You have to start thinking about pulling out gradually of these speculative assets, and try and go into something more basic and something that would cover you in the event of any shock. The last thing I want to say before I open the floor for questions is that in the event that we have a major shock in the market, don't see it as a negative, because shocks in the market create a real opportunity for wealth transfer. Remember that when bubbles burst, it is not only bad assets that lose value, a lot of good assets also lose value significantly. As it is said, the markets are driven by two emotions, the emotions of greed and the emotions of fear. Greed causes markets or bubbles to form. And then when these bubbles burst, fear takes the market in the opposite direction, where you will have very good assets selling at very low prices. So in the event that we get a major shock in the market this year, instead of panicking and trying to, I don't know, be negative about it, I think you should see it as an opportunity for wealth transfer, but you have to start positioning yourself now so that you'll be able to take advantage should any such event happen. However, as Warren Buffett would say, you cannot behave like a mortician, somebody who runs a morgue, who is sitting there waiting for a pandemic, saying that I'm there, I'm just preparing myself, I'm waiting for a pandemic, because if a pandemic happens, there's going to be a lot of dead bodies for me to work on. No, you cannot think like that. You have to think about what the best thing to invest in today. But in the event that a pandemic happens also, you have to be prepared to be able to absorb or take advantage of the extra goodies that will come out from that unfortunate event that has happened. Thank you very much, Henry. I'll hand over to you.
Thank you very much, William. We appreciate your teaching and financial education. Unfortunately, we are still unable to reach Oak. But whilst he works on getting back to join us. Still can't find him here. But anyway, we can proceed with your questions. If you have more, please do well to type them in the chat session so that we'll respond to them as the webinar continues. Okay, so William, the first question here is from Eddie. Eddie wants to know, is 2022 the one occasion where holding the US dollar is the right investment strategy?
Yeah, it's a difficult one to answer. Well, what I'll say is that holding a dollar and not earning money on it is hardly ever a good investment. In the short term, you may make money depending on how the market goes, but in the long term, hardly is it a good investment. So rather than think about it that way, rather what you have to think about is, how can I take advantage of the increasing yields, for instance, on Government of Ghana Euro bonds, these dollar-denominated bonds that are currently trading at in some instances more than 12% yield on the dollar. Okay. Now, it is not available to the ordinary retail investor because of how much you need to invest in it and the custody fees and all that. However, I know that there are a few institutions that are able to pool their customers together and invest in these instruments. So you have to rather think about it that way. Should I put some money in a high yielding dollar denominated instrument? Is it risk-free? No, it is not risk-free, because even though it's a government instrument, it is dollar denominated. The government must earn foreign exchange to be able to honor its obligation under these bonds. However, we know that we have never defaulted before. There is something that happens when a country is on the brink of defaulting. You would have the Bretton Woods institutions come in to come and support these countries so that they never default. So now the question that is being asked is that, why are these countries now having to pay that very high interest rates? Because basically, investors are not made to suffer the risk that they incurred by buying these high-risk foreign denominated bonds by the intervention of these Bretton Woods institutions. So why are these companies still paying that very high interest rate on the bonds? But that's a global political issue. So, but the point I'm saying is that it is not a risk-free venture. However, the risk that there's going to be a default is very minimal. At the risk of defaulting, what will rather happen is that Ghana will go under some kind of IMF program. IMF will put restrictions on us. They will give us the foreign exchange we need to be able to meet this interest obligations, etc. That is what has been happening. It's not right, but that's what happens. So the risk to you as an investor is not very high. So instead of just holding dollars, I would say think about or look at avenues for you to be able to buy these dollar-denominated bonds, because that covers you both ways. Even if the cedi does not depreciate, you're still earning 12% on the dollar. If the cedi depreciates in addition to that, then that becomes even a bigger bonus. So that's what I'll say about that.
Okay, thank you very much, William. We have another question from Frank. Frank is saying that he has been redundant for about 6 months, and his main question is, should I invest? Okay, so he was paid redundancy money, right? He's asking, should I invest this redundancy money into treasury bills or government bonds?
Oh, okay. Okay, so
yeah,
we hardly ever advise anyone to buy treasury bills because even if you want to invest, so I'm happy that the two things that he mentioned are both low risk investment, treasury bill and treasury bond. So lending money to government short term against lending money to government long term. Now, in his case of redundancy, you have to do something low risk. So it's a good approach. Now, the reason why I said that we hardly advise anyone to buy treasury bills is that there's some inefficiency in our Ghanaian market, where, for instance, if you bought a bond that originally was issued as, let's say, a 3-year bond or a 5-year bond, and that bond has, say, 100 days to mature, the yield on that bond should not be significantly different from a 91-day treasury bill, but it is significantly different. Okay, so you can buy a bond that has 91 days to mature, 80 days to mature, whatever, and your yield on that bond is significantly higher than the return that you are getting when you buy a treasury bill. Meanwhile, your exposure is to the same government. Okay, so because of that inefficiency we see in the market, even where you are investing short term, we still would rather buy GOG bonds that have a shorter term to mature. But if the specific question you are asking is, should you be locking your money in long term or you should be locking your money in short term, I would say, depending on the quantum of what you are dealing with, you have to have some long term and have some short term. So you put some in long term bonds, and then you also put some in shorter dated government securities. But if you want to do proper financial planning to be able to take very good decisions on that, we probably will have to talk more after this seminar. I don't think we can use this forum to address it completely.
Okay, thank you very much, William. So there are participants who are asking you to give us a brief something about the US markets, any information about the US market, since they haven't got much about the US markets.
Okay. So I think I already shared a few things about what's happening in the US market. I mean, anyone who's paying attention knows that one of the key things that the US market is dealing with is high inflation. And I explained why the high inflation came about. Tried to do quantitative easing, put money in people's pockets, expecting that the money in people's pockets will lead to these people spending the money, which will lead to businesses becoming prosperous. These businesses will hire people, the economy will get back on track, everybody will be happy. There'll be no inflation, there'll be high productivity, there'll be high incomes, government will earn the money back in taxes on the back, everybody will be smiling. So in the perfect world, that should work. However, the money went out to people. The people were willing to go out there and spend. The companies were not ready to produce for people to spend. So classic Saito, if I would say, Saito definition of inflation. Too much money chasing too few goods. High inflation. Okay, so high inflation is something that the US is dealing with. And interest rates in the US has been very low for a very long period of time. Very, very long, even before COVID, okay? Starting from 2008, there was a lot of quantitative easing. A lot of cheap money came into the US market. Along the line, after some years, when they believed that things had been stabilized, they started raising interest rates up gradually, which works fine under normal circumstances, except that in current times, the circumstances are different. But if the monies that are given to people can go into the real sector, people get jobs, etc., then productivity increases, and then you start increasing interest rate gradually over a long period of time, and then you take interest rates back to where they normally are. So they did that, but it wasn't sustain over a long period of time, and they had to go back into quantitative easing again, put money into people's pockets because of COVID. And as I explained, this time it's a bit different. Now, they are not panicking about it. They are not taking any panic decisions, because I think they believe that it's a short-term situation and it is going to correct itself. Now, but all this while that all this period of quantitative easing led to a lot of cheap money going into the US stock market. So the US stock market prices are really high relative to the fundamentals of the companies there. So as I was explaining, the price multiples on the US market are higher than they were before the 2008 financial crisis, higher than they were before the dot-com bubble burst. Okay, so we are talking pretty high valuations on the US market. And then there's negative real return. Interest rates are near zero. Inflation, I don't know, 6-7%. The people in the US even believe that it's higher than the 7% that is being reported. But it cannot continue. If the trend does not in itself start reducing, something drastic has to be happening. And that drastic thing will be a sharp increase in interest rates. And if there's a sharp increase in interest rate, it's going to have a ripple effect. The stock market is going to take the panic that was going to happen probably is what is going to lead to the tipping off, because already prices are very high. Already a lot of money has gone into all sorts. The crypto space has taken a lot of money, and the majority of people putting money in the crypto space have no idea what they are investing in. They don't have a clue what they are investing in. They just want to participate in some kind of bubble and also make some money. Now, when panic happens, people start jumping out of all these assets. The ripple effect is going to be a major corrections in market. So that's what I'll say about the US market. But it's not just the US, it's the global market. Things are not looking that sexy, if I should say.
Okay. All right. Oak is here. Oh, can you hear me?
Mute me. So I can hear you now. Can you hear me?
Okay.
Can you
Yes,
hear me?
we can hear you, but your network is still not so stable.
Okay. All right. So, but you can hear me if you can hear me speaking, right?
Yes, but the connection is still unstable, so we don't know. But it's better.
It's better. Okay. So I just a short, thank you, William, for actually setting the tone and filling in whatever. But I just want to make a short comment. And the comment is this, I've always said that there's a book that I really love called Against the Gods, right? And if you read that book, one of the things that you get to understand is that whenever there's land rush, as William said, whenever there's disruption and risk, wherever there's any major trend, the people who have the audacity and the boldness to follow it end up also being rewarded, right? Investing is not easy. If it's easy to make money, everybody else will be doing it, and it will not be something that will be competitive, right? So one of the things that I would say is that, as William said, keeping your money in cities right now and doing a lot of stuff in cities, you're facing two things, the inflation and the depreciation, right? I cannot tell you how many people in Ghana who actually ended up retiring, getting their payout from SNIT, and finding out that they could not buy a lot of stuff that they had actually planned on, right? So, we don't really have time to go into the details, but I would say this. Try and think about the areas that you like, that you think you can have the time to understand, and then begin to think about how you can find extra money or your extra money to actually invest in it, right? I mean, I'll give you a specific example. Most people would sit on Facebook and make a lot of noise. They will use Facebook, they will argue and whatnot. When Facebook was $45 and there were so many people getting on Facebook, a lot of people did not invest in Facebook until Facebook reached about $320, right? So those who were bold at that time and recognized that this is a trend that's going on, is someday it's going to be big, they jumped in. Today, there are other areas that trends are emerging that basically you have to ask yourself. I mean, Airbnb is a very incredibly lucrative trend that's going on. It's not ending anytime soon. So if you actually could team up with some friends and actually pull your money together to even do an Airbnb in Ghana, I kid you not, about 5 years, 7 years, 10 years from now, you'll probably be much better off. You'll be happy you did it. So the big trends that are happening and changing in the world, you cannot change the interest rate environment. Somebody else runs the Fed. Somebody else is running BOG. You cannot change the depreciation of the dollar. Ever since we had the dollar, it's always been, going against the city in one way. So you cannot change anything about the city. But what you can do is decide on the areas that you're going to spend the time to understand and spend the time to put in the effort, and then use your money to say, okay, how do I build something because I understand this area, I like this area. Don't go chasing things because you do not manage the environment. So that's all I would say. Next time we have enough time, hopefully I won't have an emergency and I can get into it more. So thank you guys. So let me turn it back to you then.
Okay, thank you very much, Oak, for getting back to us. We just hope your emergency is sorted out as soon as possible. But yeah, great insight there from Oak. We'll just move back to our Q&A session. Oak, I don't know if you'll be able to take a few questions for us, but we'll throw some at you.
Okay, no problem. If I could, I would take it. Okay.
All right, thank you. William, I think you can take this one. He's asking, I noticed in your slide areas where people invest. There are derivatives. What are those? What are those?
Okay, so derivative is a broad term that describe any financial instruments that is underpinned by another asset. So you create a financial asset, and the value of that asset is determined by the value of that financial instrument that has been created is determined by an underlying asset. Let me give you a local example that will help you understand. On the Ghana Stock Exchange now, there is something listed there called something gold ETF. Harry, do you remember the name? It's a gold ETF. It's an exchange traded fund. Now, how this works is that today, if you want to invest in gold and you want to invest directly in gold, you have to first go and find someone who is selling gold. You have to make sure that that person is genuine. And then when you get the gold and he says it is XYZ carat, you need to be able to go and test it and ensure that it is that carat of gold. And then you do the transaction with all the regulation and paperwork involved. Then now you have to think about where you are going to store the dollar. Okay. Now, instead of doing that, a financial institution comes in, buys the dollar, buys the gold. That's where you keep the dollar, where you keep your gold, where you are going to save your gold. So this financial institution comes in, buys the gold. They have the capacity to test it and all that, and they put it in some safe place in a depository somewhere, Switzerland or whatever it is. Now, on the back of the value of that gold that is sitting there, they issue papers, financial instruments, backed by the gold that is sitting in the depository. So that as the price of gold changes, the price of that financial instrument that you are holding also changes based on what the price of gold is doing. So you end up having an exposure to gold without you physically holding gold. Okay, so that's an example of a derivative, but a derivative is any financial instrument that is backed by the value of another asset.
Okay, thank you very much, William. The next question is asking, what role has the banking sector cleanup played in the perceived undervaluation of banking stocks?
Very, very good question. Yes. So, the markets generally react very badly to any shocks. Money doesn't like noise. As a friend of mine told me, so money doesn't like noise. Now, so the cleanup or the problem we face in the banking sector, where people had their money locked up and all that, created quite a bit of uncertainty, and people shied away from financial institutions generally. Even though the commercial banks, the investor banks, were largely well managed. Okay, there were a few that had issues, but we all know them, they closed down. But those that remained were largely well capitalized. They had very good corporate governance structures and things like that. The general dissatisfaction in the market, or the general turbulence that the cleanup caused in the market, had an effect. And it had an effect not just on banking stocks, but it had an effect on all stocks. Except that with the banks having cleaned up their balance sheets, they now could post very good financial results, but the stock market was not reacting to it. So it led to the undervaluation, especially in the banking sector, becoming more pronounced than the other areas.
Okay. William, yes. Can you hear me?
I can hear you.
Okay. All right. I didn't quite get the conclusion there, but Oak, can you hear me? All right. So let's just continue with the questions. This Gabriel is asking, what are your thoughts on real estate investments, particularly residential rental properties in Ghana?
Okay. So there are some places in the market that make sense for rental, but a lot of places in the market, if you look at the capital values and you compare the capital values to the rental values, you would see that they don't make sense. So let me give you an example. So let's say you have $120,000 to put in real estate. That $120,000 could buy you a one-bedroom apartment in Cantonments. And that same $120,000 could buy you probably a three-bedroom house at some place like, I don't know, far away, more like Kaswa or somewhere like that. So it's $120,000 spent. One is a three-bedroom house on a quarter on an acre of land with trees and everything. Looks like a nice place to stay. The other is a one-bedroom apartment in Cantonments. But if the reason for your investment is not a place to stay, and you are thinking about really as an investment asset, then you ask yourself, what rent can I get on the one-bedroom apartment in Cantonments? And what rent can I get on a three-bedroom house in Kaswa? You would see that there's a huge difference between the rent that you get on the one-bedroom apartment in Cantonments and then the rent you get on a three-bedroom house in Kaswa. The Cantonment apartment will give you a much higher income than a three-bedroom house far away from town. Now, which one would you get a higher occupancy rate? If it's a one bed or a studio, the occupancy rates tend to be very high because people prefer to be in those apartments rather than being in hotel. So if it's just a one bed or a studio apartment, it tends to have a much higher occupancy rate. 3-bedroom house out of town, usually difficult to get suitable people to pick it up all the time. So if you're thinking purely in terms of income from real estate, you have to be very careful where you put your money. Most of the time, it makes a lot of sense if you buy just a 1-bedroom or a studio apartment at the up end of the market. However, that is also not risk-free because remember that the demand for that market is mainly expatriate community and people, or even if it's Ghanaians, people who are coming into town, they are not based here, coming to town for a short time and go back, etc. Now, so anytime there is anything like COVID time, I have friends who are into that business, and the COVID hit them significantly when the period that the borders were closed, because that's where their traffic comes from. So you have to look at it well. But for the city market, you have to do your numbers really, really, really well. Sometimes you would see that it would make more sense if you build very simple structures, 1-bedroom, chamber and hall, and have many of that on that same plot of land and rented them, than to have a big 3-bedroom or 4-bedroom house to rent out to one family unit. However, you also have to think about maintenance and how well those properties will be taken care of. So it's a bit complicated. It is for that reason that you would see that most of the people in the real estate business in Ghana, they build it to sell. They are not in the business of rentals. The guys in the rental business are mainly buying small 1-bed studio apartments at the up end of the market. Henry, can you hear me?
Can you hear me, William?
Yes, I can hear you. I think you are good.
Okay, great. We have William, Peter here. Peter, can you hear me?
Can you hear me?
Yes, we can.
You can hear me? Okay, perfect. William,
Yes.
First of all, thank you so much for such a brilliant presentation. I think it's probably the easiest presentation I've seen when it comes to the financial markets. So my question is really around the things that we always hear, which is don't waste the crisis, right? Yeah. And we're sitting in a 2-year pandemic situation. Yeah. At the same time, you've highlighted an economic outlook, which is a bit of a conundrum. Whether you talk about the US, the UK, or Ghana, facing some facing downgrade, some interest rates going up, inflation, and so forth. So knowing what you know and knowing what we know right now, 2 years of the pandemic, and we don't want to wait the crisis, but at the same time, we're facing the economic outlook, which is not that great. What would you advise that we do right now versus long term?
Wow. Okay. So that's the dilemma everyone is facing. So for instance, if you take Warren Buffett is sitting on a lot of cash now. Now, because why is he sitting on a lot of cash? He's not sitting on a lot of cash because he is hoping for some disaster to happen for him to take advantage of it. No. He's sitting on a lot of cash because there's not much opportunity for him to use money wisely now. So short term, I don't know whether you are in Ghana or you're out of Ghana, but let me speak to those in Ghana. Look, what we're doing now is that we recognize that the economic outlook is not that great. So our approach is that we are taking low risk. Taking low risk, we're buying government bonds. Luckily for us, for those of us on this side, you can buy a government bond and then 21% if you buy long-term bonds. Even if you want to buy a short-term government instrument, you can buy bonds that are maturing in less than 1 year and still earn a decent 17% thereabout. Okay, so for us, we're doing that. The other thing we're doing is lending, giving our money to people who are lending to people on government payroll. As I explained, it is not risk-free. However, on the scale of things, even where there are delays, the money eventually comes. So their portfolio at risk usually is under 10%. Okay, so it makes us comfortable. So we put money in there. Safe short-term places that you can put your money. Better than holding cash. Okay, Warren Buffett is forced to hold cash because there's no safe place for him to put money and earn money. If he buys government instruments, he's getting 0%, 0 point something percent. So he's holding a lot of cash. We, on the other hand, can do safe investments and still make some money. If you have a lot of money to invest, I'll say buy government of Ghana Euro bonds because the yields are crazy high, 12%, 13%. And like I said, instead of these loans going bad, worst case scenario, some institution will come in, IMF will come in, give us all sorts of conditionalities, and then give us money so that we don't default. Now, the reason why these institutions do that is because they want to protect their own economy. They are not doing it for our good. They want to protect their economies because if we default and people are taking losses over there, one default can lead to panic and then people want to pull out. So Ghana has defaulted. Ghana has never defaulted before. Ghana has defaulted. Which other emerging market is going to default? Let's pull all our money from all emerging markets. Then it starts creating a panic. So they will protect that from happening. So it gives you some kind of assurance that even though it is not a risk-free investment, it's still comfortable. And you still have money in something that is relatively liquid and you can quickly move it around and invest them somewhere else should market conditions change. But if you are in the US market, if you are in the US market, it's very difficult for me to give you an answer because it's hard to find assets today in the US market that makes a lot of sense to put money in.
All right. My sincere apologies. I think I had a connection problem, but I'm back. I'll just continue with this question. William, can you hear me?
Yeah, I can hear you.
Okay, great. So someone wants to know, could the presenter speak to investments in other areas such as agri and the services sector?
Okay, so I assume he's talking about a direct investment.
Yes.
Okay. So talking about agri, I have a lot of personal exposure to the agri space, and I can tell you that is one of the most challenging spaces to be in. Extremely, extremely challenging. It's hard. So if you want to go into that space, you know, after being in direct investment in production and the agri space, what I tell people is that it is better to start by positioning yourself first somewhere in the value chain. Okay, so maybe all you're doing is that you are an aggregator. You are not into production. If it's peanuts that you are aggregating, you have a deal with a lot of producers, you aggregate, and then you move it on to the next level in the chain. Someone who is using a peanut to do whatever, peanut butter or whatever it is. Okay, so if you position yourself somewhere like that in the value chain, it becomes easier for you to either integrate backward or integrate forward. Okay, so it's better to start somewhere like that in the value chain because I can assure you that production is hard. production in agribusiness, especially in Ghana, is really, really, really tough. I can give you a few examples if we have time, but Henry, do we have, okay, let me put this in. So there's a project that I'm involved in. It's a rice project. Okay, so the investments have been done. We have one of the biggest silos. In fact, I think it's the biggest silo in the southern belt of Ghana. Okay, so we have the silos. We have 500 acres of land. We have a rice mill. We have a dryer. We have everything. Okay, and the investments have been done. Now, however, we need a lot more rice to feed our mill to be able to operate at any level that makes sense. Okay. Now, so what do? You now go into agreements with other rice farmers in the area, and you say, we're going to give you input. Produce rice for us. We're going to buy the rice off you, prevailing market price at the time you produce. And then we're going to take out the input cost, and then we take your rice. We'll test it, if the quality passes, etc. And we give you your money. Okay. So agreements are signed, monies are advanced to these farmers, etc. And then year one, the rains fail. And the yields, I mean, we're expecting yields of about 3 metric tons per hectare. We ended up with yields of 0.8 metric tons per hectare. So the rice that the farmer has produced is not enough to cover the input cost that you gave him. So you ended up that season with a lot of money that we could not collect from farmers because the yields failed. Now, the next year, what are you going to do? This farmer who is farming 3 acres, 5 acres of rice doesn't have money anywhere to pay you back your money. The only thing is that he has to be able to produce rice to use that rice to pay you. So what are you going to do? Are you now going to give him money for the next season, hoping that in the next season, he's going to be able to produce enough rice to cover the money you've given him the previous season that he could not cover, plus the money you've given him this season? Are you not going to end up throwing good money after bad money? This is just one example. If as for agri-space, if you want me to give you examples, we won't leave here. But it's a very tough area to be in.
I think we can have another discussion on that.
Yes.
So
yeah,
maybe some other time.
yeah.
So we'll just have a separate discussion on investing in the
agri-space. Place yourself somewhere. And you mentioned service. Yes, so even in the agri-space, please position yourself somewhere where you are rendering a service. You are an aggregator or something. I think it's a good starting point when you want to venture into an entrepreneurial activity.
Okay. All right. Great. We have George on the line. George, can you hear me?
Yes, I can. Good evening, everyone.
Okay, George. Good evening,
hello, please,
George.
can you hear
Please
me?
go on.
All
yes,
right.
we can hear you.
Yes, we can.
Okay. Investment bankers normally advise investors to diversify their investments, and I think it's a good call. The reason they normally give is that you reduce the amount of risk you are exposed to, and then you maximize your returns also when you, in fact, diversify your investments. But my question here is that, is it always right to do that? Because as you alluded to in your submission, William, you said the Ghana Stock Exchange has been performing very badly in the last 2 to 3 years, and it's a fact. So it's not attractive for people to invest there. So let's say if I have an investment, I have a mutual fund, let's say a money market investment I'm already doing. I want to go into equities. I will not do that. I'll shy away because it's not attractive. I may lose money there, and maybe I may be a risk-averse investor, so I'll not like to go there. So in that case, should I still go into diversification if the one that I'm doing is fetching me some good returns? Can't I stick to that and then make some money there? And then my second question to have to do is, what is your take on offshore investments? Yeah, I'm asking this because the New York Stock Exchange is the largest stock exchange in the world with an equity market capitalization of over $28.2 trillion. So if you are in Ghana here and your exchange is not doing well, why can't you invest offshore? Because I don't know of any brokerage firm, investment brokerage firm in Ghana that does that. I mean, that advise his clients to do offshore investment. Is it legal, and is it the best? If in fact the stock exchange elsewhere is vibrant, is doing well, why can't you invest there? So I want to know your take on that.
Okay, thank you very much. So in fact, both your two questions are not too different, because when you invest offshore, you are still also diversifying. Anyway, so let's talk about diversification first. Now, I often say this, there are two sayings. The first one is that don't put all your eggs in one basket. And there's a second saying that says put all your eggs in one basket, watch the basket carefully. Now, I often say this, that if you understand what those two statements are saying, even though they appear like two opposites, don't put all your eggs in one basket. The other one says put all your eggs in one basket, watch the basket carefully. Now, if you really understand the import of those two statements, they are not that much different. Because when we talk about diversification, we are not alluding to blind diversification. To quote the Bible, a sower went out to sow. He put the grains in his hand and then he started throwing the seed. He just scattered it. Some fell in thorns, some fell on hard ground, some fell, and then perchance, some fell on fertile ground. That is blind diversification. So basically, you are diversifying just for the sake of diversification. That is not what the essence of diversification is. So if I say don't put all your eggs in one basket, I'm not saying that go and take one basket that you know, at the time you took the basket, you know that the base of that basket is broken, okay? But just for the sake of diversification, well, I shouldn't put all my eggs in one basket. Even though this basket, the base is broken, I still want to put some eggs in that basket. That's not what diversification is. What diversification is saying is that if you can find 3, 4, let's say even 10 suitable investments, you're better off putting your money across these suitable investments than to say, of all these suitable investments, I think this particular one is the best, so I'm going to put all that money in one, because of the element of uncertainty. But it doesn't say that just because you want to diversify, still look for other things, even when it does not fit your investment objective, it does not fit your risk return profile, etc. Still put your money in there. No. Okay, so look for suitable investment. If you find only one suitable investment, yes, put your money in that one suitable investment. But if you can find 5, 3, 4, 5, 6 suitable investment, don't put your money in just that one, because of the element of uncertainty. Okay, so that's it with diversification. Now, offshore investment. So I was watching one financial advisor talking, and the financial advisor was saying that when you are investing, you have to think global. So basically, what he was advocating is that if you look at the global market, let's say the US market is, let's say, 40% of global markets. Europe is 20%. Asia is this percent. He is advocating that you have your portfolio invested like that. You have a certain percentage in Europe, a certain percentage in US, etc. However, it is rare that you find portfolios like that. Now, the reason being that people invest where they are comfortable. Where they are comfortable. I mean, if you ask me to go and invest in Asia, I don't even know where to start. The reason why I'll have the bulk of my portfolio in Ghana is that if you wake me up from bed today and you ask me a question about the Ghanaian market, I'll be able to answer. Okay, so I'm very comfortable here. I understand the market. I know the market. If I'm investing in shares in Ghana, it's easy because I know the market. If you ask me to go and invest in shares in Europe, it's going to take a lot of work for me to understand that market as much as I understand this market. So the reason why people end up concentrating their portfolios where they are is because they are very comfortable with the market in which they are. So if you can build your capacity to understand those other markets, then yes, build that capacity and invest. However, if you don't build your capacity and you still want to invest outside, I probably would give you the advice Warren Buffett gives to all retail investors. Buy into an index fund. Get exposure to the whole market. Don't go trying to invest in specific areas when you have not built the capacity to understand the market and be able to make informed decisions there. If you say, I want to have an exposure to Europe, buy into a broad Euro index or buy into an S&P 500 index or something so that you have an exposure to the whole market and not specific exposure. But if you can build a capacity, please do build a capacity and then diversify internationally. Because as I said, diversification does not mean just throw your money anywhere. It means find good assets at different places and put your money. So you should be able to have the capacity to find a good asset offshore in the first place.
Great, thank you very much. Oak, can you also share your thoughts with us on the diversification question?
Yeah, so can you hear me?
Yes, we can.
Okay, all right. So I actually, I mean, my thoughts are, you're trying to make sure that in 2020 you have a place where you can put your money and make sure you're protected. And by the end of 2022, you have had a bit of a gain and sort of has increased your wealth. I'm not very big on this whole portfolio theory and all the stuff. One of my professors was actually a guy called Jim Farmer. He's the guy who did a whole lot of asset pricing theory and whatnot. He told me in class, he said, if there's anything I did not teach you or you don't learn from this class, let me give you this one piece of advice. Don't invest in mutual funds, right? That was his advice to me, right? And the reason being that there's a reason why big financial firms invest in mutual funds, because you've given them your money. They want it to be safe, but they also get paid by fees. You're not running a mutual fund. So if you give your money to someone who's running a mutual fund and it's well diversified and whatnot, that's all you get. You'll get average returns. You will not get ahead, right? So my thing is diversification. There's financial planners will tell you all this, but at the end of the day, people like Warren Buffett or any rich guy you see makes money and they're able to get ahead because they have chosen specific areas where they have concentrated exposure, and it makes the money because they understand it. They can spend the time to work it. They know how to manage it. They know how to put money into it. They know how to take money out of it, right? So, I mean, Elon Musk, Tesla makes money and has made a lot of billions because he has a concentrated exposure to something he understands, and that's Tesla, and that's transformational, and he spends the time on it. He puts his money into it, his life savings into it, and whatnot. Warren Buffett understands insurance, everything that has to do with insurance, giving insurance right over cover call to a financial company. He would do it because he understands it, right? The reason why I am sort of trying to push folks on here is that if you want to have a difference in how you invest your money, from now 2 years, 3 years, 5 years, and whatnot. You have to do the hard work in saying, okay, what areas do I understand? What areas do I have passion for? Is it transformational? And how do I get exposure to it, right? I personally, I've come to love places like Snapchat, right? So I invest in Snapchat. Well, because I've spent the time to understand it, I've gone in and I know also that there's transformation that's happening. People are talking about metaverse and all these stuff, right? 5 years, 10 years from now, if it gets big, guess what? I will also benefit. I'm not going to invest in places where I don't understand or places where I seriously do not have interest. So please, whatever your life's work and your passion is, for me, I think that is the first advantage that you have. Follow your heart, follow your passion, specific areas. I know William.
Okay, I think we lost Oak again. That's unfortunate.
I've been done in the past
Okay,
before, where I woke up about 6 months later, and I had gone from three cities to the dollar to 5 cities to the dollar, and I was like, man, I would never do this again, right? So that is the comment that I have on. I mean, diversification is fine. It's a nice story. People talk about it, but the folks who have to do diversification have a mandate. They get rewarded for that. You and your own money, the only thing that you're going to get rewarded for is your passion and basically saying, okay, I want to be diversified, I want to do something, right? So to me, I guess basically it's time and sort of with your resources and what you have passion about. So that's the only comment that I have.
Okay, thank you very much, Oak. I think we'll just take the last question, then we can take final words and then conclude this webinar. So we have a question about buying government of Ghana Euro bonds. Someone is asking, how do they invest or buy government of Ghana Euro bonds?
So the question that I have for the person who asked the question is this: why do you want to buy Ghana Euro bonds? What is driving you that you're asking that question? What interests you about Ghana Euro bonds?
I may not be able to answer that. So,
so basically what he's saying is that don't just buy something because you heard. Remember what I said. You don't follow facts like this is the in thing. What is good for somebody might be an absolute disaster for you. So there must be a reason behind it. Now, there's this saying, it says, when your heart decides a destination, the mind will draw a map to reach the place. Okay, so the first thing is let your heart decide a destination. What is it that you want to achieve? Do that work first. Now, the specifics, how to get it done, is the easier part of it. Okay, because really, if after doing the real work that needs to be done, Eurobond is part of what has to go, what you have to invest in. It's easy to get the investment in Eurobonds. Okay, there are a number of brokers in town who can. I mean, the problem with the Eurobond is that the amount of money you need to be able to buy is pretty high. Okay, there are people who are aggregating to buy together for individuals who come together are not many, but there are even still opportunities like that for you to do it. So the specifics, those are easy, but the key thing is think about the big picture.
okay, thank you very much. I think that will be all for the Q&A session because our time is fast spent. But before we close, we'll just take your final thoughts, final words about where to invest in 2022.
Okay, so my final words would be that really, even though the subject is where to invest in 2022, there is nothing like that says where should I invest in 2022, but rather what you should be thinking about in 2022 are the big things. What are my financial goals? How will I be able to achieve these financial goals? What do I have to, what capacity building do I need to develop? How do I expand my circle of competence to be able to understand specific things that I have an interest in, to be able to take advantage of that? I think that in 2022, that should be our thinking. Now, once you get that sorted, once you get that big picture sorted, the easier part is how do you go about doing the specific things to be able to do that. The other thing I'll say is that once you decide where you are going, forget about what everybody else is doing. Don't be swayed by recent trends. Don't be swayed by the fear of missing out of something. Know what is good for you, stick with it, and then at the end of the day, you will meet your financial plans.
Okay.
Okay.
So, yeah, so let me add to what William just said. So, what I'm thinking is, for people that actually are on the call right now, I'm assuming most of you are not retired, right, yet. So someday you're going to retire. So you first have to think about, someday when you retire, you have to be able to replace your income. You have to be able to make sure that you have the income that's coming in so that you can actually enjoy your life, right? That means that it's quite a long way off. So what my suggestion would be for 2022 is this. Think carefully about what is happening in the world and the trends that's happening in this world today. Because 10 years ago, 10 years ago, I was in London when someone actually said, do you want to invest in Tesla? At that time, Tesla was $80. And I remember telling the guy that, oh my goodness, I mean, this car is so expensive. And one of the guys that actually worked with me traveled to California, drove the car, came back, got a group of us together and said, oh, by the way, guess what? The car is amazing, right? That moved us, a lot of us over. It was a group of us. At that same time, there was a company that was starting right opposite our office, and it was actually doing coffee. That time, Starbucks was big and whatnot. So what I would say is that just think about the areas that are actually emerging right now. Airbnb, delivery systems like DoorDash, all these things that are also happening in Ghana. Those areas are transforming the whole world, So 10 years from now, if you actually get exposure somehow to those areas today, I'll tell you 10 years from now, 5 years from now, when you retire, the place where you put your money you would have been much, much more rewarded, right? So let me caution you again, in much like what William is saying, your passions, but keep a look on your passions with respect to what is really happening right now. The world is changing. There's no point going and putting money in some gold company or oil company or whatever, unless you understand it or unless you love it and you want exposure to it. Other than that, I would say for 2022, take a look at all the things that are emerging, right? Cryptocurrencies, a lot of people talk about it. My approach to cryptocurrencies is that spend the time to understand how each solution is being created. Cryptocurrencies are done to solve specific problems. So read up on it. Go to Coinbase, read up on it and say, okay, do I really, really buy into this or that or that or that before you even think about putting money into it, right? So thank you guys for having myself and William on there. Hopefully they can share my email with you guys. And I'm happy to answer questions for you if you actually shoot me an email, right? Okay. So thanks, William, for being on with me.
Okay, thank you very much, Oak. We'll be ending the meeting. Give a few announcements. As we have said earlier, this webinar, or as you already know, this webinar is proudly brought to you by investingh. investingh is the leading provider of financial news and education in Ghana. Over the years, our news, magazines, and more recently, our webinars have been delivered to thousands of people in Ghana and beyond. We have previous webinars. We've hosted quite a few on topics ranging from mutual funds to stocks to real estate investments to cryptocurrencies. So if you want to get access to all our previous webinars, they are available for viewing, for downloads on our YouTube channel, investingh. So you can visit our YouTube channel and then watch any of our previous webinars. Also, if you want to get in touch with us, we have a WhatsApp group. I've already shared the link in the chat session, but if you didn't get it, I'll just share it afterwards. So just wait and then share it so that you get it. All our chat groups share the same content, so there's no need being in two chat groups. You just have to be in one. The contents will be the same. And also, you can reach us via mail at investingh18@gmail.com. But do well to send us a message on WhatsApp anytime. Any of the admins can respond to any question that you have. And resources that have been shared during this presentation or any books that have been mentioned will be made available after the webinar via mail and also in the WhatsApp group. So just get in touch with us. I think that'll be all. Just do well to continue to patronize us. We appreciate you and thank you for spending your evening with us. Enjoy the rest of your weekend. It's bye for now.